Hello, everyone, and a big welcome to all of you joining us this afternoon. Thank you so much for taking the time to be here today. We're excited to bring you the first call in our new quarterly market commentary series with information presented by our Chief Investment Officer, Mike Serio. I'm Caitlin Spain. I am our strategy administrator here at Trilogy. I've been here for 7 years, and we're really looking forward to this. Now that we've got Mike Serio on board, we are leveling up our investments, and we're really excited to bring you some additional information about what's going on in the world, what's going on in the economy and in the market space. So we'll be jumping into that in just a minute. But before we get there, I want to let you know you might notice there's no chat feature on today's webinar. If you have any questions during the call and you want those answered at the end when we get to Q&A, please feel free to use the email address that is on the screen, investment.team@trilogyfs.com. I'll be receiving emails at that inbox, and you can send your questions there. We'll address those at the end of the call today. Let's talk a little bit about Mike before we jump into what he's got for you today. He is the Chief Investment Officer of Trilogy Capital, and he's responsible for investment strategy and client communications. He oversees $4 billion in client assets here. He's also got over 30 years of Wall Street experience as a portfolio manager, a strategist, and a chief investment officer. He has frequently been quoted in the Wall Street Journal, the New York Times, Bloomberg, and the Washington Post, amongst other publications. Formerly, he was an adjunct professor at the University of Denver and DePaul University. He worked on the Russian project for the United States Agency for International Development in the formation of capital markets in the former Soviet Union. Prior to working at Trilogy, Mike co-founded Wolf Creek Energy Partners, which financed non-operating working interests in the exploration and production of oil and gas. He earned a bachelor's degree in economics from the University of Illinois. He has an MBA in finance from DePaul University and is also a CFA, a chartered financial analyst, and a CAIA, a chartered alternative investment analyst. So Mike, with that, super excited for what you have in store today. I'll turn it over to you.
Great. Thank you, Caitlin. Throughout the presentation, certainly if you have a question, if you can see the email address there, it's investment.team@trilogyfs.com. Please, if you have any questions or comments, let us know, because we're certainly doing this for our clients, and we want to make sure we're hitting everything you want to talk about. So let's talk. What do we want to talk about today? We're going to start with the macro environment. We're going to talk about inflation and how important the Fed is in fighting inflation. We're going to talk about tightening, historical pauses and easing, and what the market does in light of those. I haven't done a presentation, and I've done hundreds over the past 10 years, where I haven't been asked about government debt and its long-term implications, And so we'll talk about that. We'll get into the stock market, what's going on with the Magnificent Seven and the dispersion going on, market cycle and history. We're going to have a couple middle of the road word on politics and economics, and a couple historic election market facts. So let's start it off with inflation. Now, if you take a look at a quote from my favorite economist of all time, Milton Friedman, he would always tell you that persistent inflation is always and everywhere a monetary phenomenon. Now, inflation starts one of two ways usually. The first would be things like the Arab oil embargo of the early 70s, or the event we just went through a couple of years ago with supply chain disruption. Now, when that happens, usually given enough time that the market figures it out, more capital comes in there, things move, and those things get worked out. But longer term, as Mr. Friedman said, it's a monetary phenomenon, which is described as too much money chasing too few goods. So if you want to take a look at the money supply out there, you can see post-COVID, money is plentiful and has been plentiful. And this is a chart that looks at one way of measuring it. It's called M2, and that's the amount of money in circulation with currency plus bank deposits and a couple other things out there. So it's a good measure of what's out there. And you can see that post-COVID, given the government's influx of money into the economy, there is a lot of money out there. And without a lot of capital being invested to produce goods and services, coupled with supply shocks, you can see that we've gone through a pretty nasty time with regards to inflation. Now, I thought this is an interesting chart, one I've used for many years, and I was happy to get it updated. And it starts at 2000, and it's fairly recent to June of 2024, and it looks at some of the inputs and some of the segments of inflation. And I find something very interesting is at the bottom there in the blue, these are goods and services that have not risen to the extent things have over the last couple of years. And partly this is free market and free trade driven. So if you can take a look at starting at zero in the year 2000, new cars are generally only up 24% in price over those 24 years. And it's pretty amazing as you look at the cars we have now versus the cars we were buying in 2000. There is no comparison. Likewise, you look at cell phone service down actually 41%, computer software 73. And I thought this was really interesting is if you look at TVs now, they're almost free when compared to the year 2000. So again, these are things where markets figure themselves out. We have free trade. One of the consequences of free trade is we're able to have better goods and services at certainly cheaper prices. Now, compare this to the top where there's less free market and free trade controlled goods. You'll see the amount of inflation in the system with these. You know, part of it is hospital services. Well, that's supplied a lot of that by Medicare and Medicaid. College, as somebody who wrote 24 big checks for 3 kids to go to college. I know that college tuition and fees were up 188%, partly fueled by the abundance of student loans, textbooks, Medicare services, and so forth. So you can see uh, when free trade is given an opportunity, it's usually pretty good for consumers. So why is this so important? Why are people kind of hurting? Well, there's a number of ways to measure inflation. So the first one we're going to look at is strictly the CPI, and that's given in the red line right there, and that's the Consumer Price Index. That's a basket of goods and services the government says that we consume. But we took it one step further and took a look at the common man CPI. So if you ever took any psychology, there's something called Maslow's hierarchy of needs. That first level would be food, shelter, water, all the things we need just to exist in life. And you can see that our uh, research partner Strategas took a look at those components of the CPI with food, energy, shelter, clothing, utilities, and insurance, and it's exceeded the CPI the government's been telling us by quite a bit, 3.2% year over the last couple of years, which is why the CPI is not necessarily a great indicator of how high prices are going or to the extent they're going. And people are feeling this, and it's certainly going to be reflected going forward, partly in politics, partly in a couple other things. One of the arguments, I guess, I get against that is that there's something called price gouging. So let's take a look at this is the consumer staples section of the S&P 500. These are things we all consume every day, soap, toilet paper, things like that. And you can see that the margins, as given by the blue line here, have actually come down since mid 2021. So I can't see this as price gouging. This is at best not being able to even pass their costs, these companies' costs through to the ultimate consumer. So they're bearing the brunt of this inflation as an investment. And we know this because the consumer staples sector has not done very well relative to technology and a couple other sectors in the S&P 500, and partly because their margins have been coming down. It's not just margins, it's real wages. So this is a graph that looks at real median income growth. When we say real, this is what you are making in way of more money, less inflation. So you can see the blue lines are showing for all sectors of the economy and things. I won't get into that, but you can see that over the years 2016 to 2019 people did quite well, but from 2020 to 2023, if you index that and take out the inflation component, they haven't done quite as well, although they have been still enjoying the rising real wages, not to the extent that you might think. So looking at historical inflation over the years, this one goes back to 1915, you can see that inflation does come in waves, and every one of those circles shows the first wave and the second wave. And I guess one of our concerns right now is we may be in one of those times where it looks like we've been pretty successful in getting rid of that first wave of inflation, but we always get worried that there's going to be another one behind it. I always want to point out to there's a book called The Great Inflation and Its Aftermath, and it discusses in 1963 when our president was assassinated and the new guy came in, and he had something called the Great Society, inherited wars he could not afford. It kind of sounds like the same thing we're going through now. And they printed money, and thus we had about a good 20 years of bad inflation. Some of us are old enough to remember 16% mortgage rates, 10-year bonds at 15% at all. We don't think it's going to be that bad, but certainly there is a probability that we're going to get another wave of inflation, and we're watching that very closely. So the Federal Reserve, and a lot of people don't understand the Federal Reserve. So if you bear with me, we're going to go through a little macroeconomics and discuss what the Fed actually does. So the Fed has a dual mandate, trying its best to control employment and inflation and keeping those at manageable levels. So in the inflation area, when inflation is above target, presently their stated target is 2%. It's probably more like two something, not quite 2%. And as we've been going through this for now about a year and a half, 2 years right now, the Fed could raise rates by selling securities. And I talked about a lot of money in the system, and that's the main backbone of inflation is when you raise rates, you slow down the economy. Um, you raise the policy target, interest rates in general, as I mentioned, rise, and the economy slows down, and we hope at that point inflation cools off. The other mandate is going to be when employment is below target. And part of the inflation problem is we had at one time twice as many open jobs as we had people seeking work. So if you put a simple supply and demand analysis to that, in order to get people back into the labor market, they had to raise wages. And that's once wage inflation gets into the market, it's very, very difficult to get rid of. Right now, we're at a little more of a Goldilocks type of environment where the amount of people looking for work is just under the amount of open jobs, so that's good. But when the employment is below target, the Fed buys securities, it lowers the policy rate, and then usually what happens is because companies can afford cheaper financing, they get what we call animal instincts and start producing things and building new factories and putting people back to work. And if everything works, that usually brings us good things. But there is a problem here, and there's complications of Fed monetary policy. You want to think of monetary policy as kind of piloting an oil tanker or an aircraft carrier, that you want to go 90 degrees to the right. You get the wheel going. It's going to take a while to get there. And if you don't start backing off before you get there, you're going to overshoot it. And we call that pushing on a string. So lags are very difficult to judge. Sometimes they're 6, 8, 10 months between when the Fed moves interest rates and when you can actually see the effect in the economy. It is passive, You can't affect aggregate demand by just lowering or raising interest rates. We always say that if all you have is a hammer, everything looks like a nail, and the Fed basically just has a hammer, and that's raising and lowering interest rates. When expected returns on projects are low and risk is high, just because money's cheap, companies won't necessarily expand and hire people. And then when interest rates, such as post-Great Financial Crisis, are near zero, you don't have much ammunition in your arsenal to combat inflation. Okay, so we beat that up pretty good. Let's talk about when the Fed starts lowering rates, as they did in September, what usually happens to markets. So here's a good one going back to 1929, and you can see that it's generally good for markets. And I'll talk about the great markets we've had over the past 2 years in a second. But you do need two main things for stock markets to go up: is you need good sales. You can't make any money unless you sell stuff. So we need companies to sell stuff, and we need lower interest rates. All are big positive for market returns. And you can see just on the interest rate side, with the exception of 2001, which was that nasty 3 year down 49% bear market where we had 9/11, we had a recession, we had a war, and then obviously the great financial crisis of 2007 to 2010. Markets did not do well when the Fed lowered rates, but those were some other issues out there that were more dominant than interest rates. But you can see since July 2019, this chart's a little old. I'm going to talk to you a little bit more, but the market has been taking that interest rate ease as a real positive. And then going forward, you can see on average, and this goes quite a way to 1960, when you have an inflection point, what usually happens? Well, it's more dominated by the expansion of the economy than it is interest rates. So you can see in those times when the Fed eased and we had an expanding economy, it's usually been pretty darn good for markets, and that's where we are right now. But if they didn't do a very good job, or there's other issues like the GFC or that other 3 year period I talked about, and we go into recession, it's usually not good for stocks. So right now, we do believe that things are on the up and up. Sales have been pretty good, probably not as good as they have been over the past couple of years. So we don't see any reason to change right now our thought that we're going to stay fully invested in equities right now, and good things should happen going forward. Now, I don't mean to to douse the flame of positivity here with some water, but there are some things, and I talked about this at the beginning, where I've been doing this for a long, long time, and not once have I not been asked if I can use a double negative about the federal debt and the amount of interest we're going to have to pay. And this gets me a little worried right here. Here's net interest cost as a percent of tax revenues. Now, these numbers do come from our research partner, Strategas, and the next one's going to come from the nonpartisan Congressional Budget Office. But you can see that net interest cost as a percent of tax revenues has basically tripled over the last year. You can't spend and spend and spend coming out of a low interest rate environment and expect to be able to continue to go forward in the future and take future tax revenues and borrow off of those to spend today's deficit. And we're not even in times of war. In times of war is when you should be spending this, or in times of recession. We've had a good economy. We're not necessarily in a direct war. We should now be enjoying lower interest rates and interest rate expenses, which we're not. And I guess one thing that gets me a little worried in this presidential cycle, nobody's talking about it. The next way we're going to look at it is, and this is by the Congressional Budget Office, is what we're going to spend on interest is going to be more than what we're spending on defense. And that's not too far in the future, assuming their projections are right. And I think what gets us a little worried, and I'm going to go back one, is something we've been talking about in economics called crowding out. So when the government has an appetite for debt, they are now competing with the private sector. So if you're a businessman and you're used to paying the bank maybe 5, 6% on your debt, or if you have a bigger business and you go out and you float bonds and you're having to refinance those at higher and higher rates because you're competing against the government, that doesn't really portend well for a great economy, because you won't have those animal instincts because your cost of capital is that much higher, and we call that crowding out. This is another thing. This is probably my last dour thing I want to talk about, but this is the government's balance sheet. Now, here at Trilogy, we've been talking to our clients, and on the other side of the balance sheet, when we say the other side, it's the client's debt part of their balance sheet. We've been coaching them up over the past 10 years to say, hey, it's a really good time to borrow money. Interest rates are artificially low. We had what was called a zero interest rate policy for a while. Certainly don't get over your skis like people did in the great financial crisis, but it's a good time to borrow fixed, and it's a good time, to borrow long. And our clients in general have done that, certainly have not got over their skis. And when inflation comes in the system, their assets rise. Maybe they're still working. They start getting some really nice raises. That debt out there is actually worth quite a lot. But unfortunately, if you look at the government's balance sheet, they are borrowing short, and they're borrowing what might be considered variable. So as rates continue to rise longer term, as they continue to have the appetite for that debt, their borrowing costs are going to be self-inflicted, and that's certainly going to go up. And that's, more money is going to be spent on interest costs than it's going to be goods and services and things the government does bring us. Okay, let's talk about stocks here for a second. That's enough macro for a while. Over the long term, there's a number of different ways to measure the stock market. The first one would be what we call market cap weighted. That's the way people usually look at the stock market, is that a company worth $10 billion is going to count more in the index than a company worth $5 billion. That's just an example. And if you look longer term on the left chart since 1973, you usually see that the equally weighted S&P 500 has outperformed the market cap weighted S&P 500. And I'll get into the reason for that in a couple minutes. But what we see now over the past 6 or 7 years, if you take a look on the right, is less dispersion. You may have in the financial news, you may have heard about or read about the Magnificent Seven. These are 7 companies that have been dominating market returns. When that line goes down on the right, that's a domination. There's less dispersion. There's a couple of issues out there dominating the market and market returns, and certainly we have been participating in those, the NVIDIAs, the Apples, the Alphabets of the world. But what we're seeing right now going forward is probably a little more dispersion, and it's probably a little more less Mag 7, more the other 493 companies. And that gets us a little excited in that it becomes a little bit more of a stock picker's market, where active management outperforms what we call passive management or indexing. And that's usually healthy for a stock market going forward, when there's participation by everybody in the market, not just 7 stocks. One reason these 7 stocks have been doing so well is they've been what we say punching over their weight, if you want to use a boxing way of looking at it. You can see in 2024 on the left, estimated earnings growth of the Magnificent Seven, those stocks, a couple of which I had mentioned, estimated to grow 57% this year versus 10 of the rest of the 493 stocks. And going forward, if analyst estimates are anywhere near close, those Mag 7 stocks should come down a little bit on the earnings growth rate from 57 to 19. And the rest of the stocks, you can see, have a good opportunity to go from 10% growth to about 14% growth. And again, that's healthy for markets going forward. I will tell you, as somebody who's been doing this over 30 years and has lived through a couple of bad markets, including the internet bubble of 95 to 99, which ended in and around March of 2000. One thing that does bother me is when you have companies dominating the market, and they are growth companies, and we define a growth company in this chart as companies being able to grow their revenue by at least 10% in consecutive years. The winners of that are few and far between. And that's for two rules. The first is called law of large numbers. If you have $1 million of sales, growing your sales by 10% isn't all that difficult. But if you have $10 billion of sales, growing it by 10% gets a lot more difficult. Just the numbers get bigger. The other factor why growth companies cannot stay growth companies for very long is you have a NVIDIA, you have an Alphabet, you have a Meta. You either have to have a business moat around it. Think of a business moat as something like having a patent where you have a guaranteed monopoly on something you invented for a certain amount of time, or something else that sets you apart. But I guarantee you, you look at a company like NVIDIA, there's firms in Bangalore and Palo Alto and all over the world that have NVIDIA in their sites looking to topple them. So if you look at the data here, in general, you look at consecutive years, you start out with 140 companies that are able to grow their sales by at least 10% in consecutive years. By the time you get 10 years out, only one company in this sample size actually did it. And there's a few companies that can do it for more than 10 or 20 years. General Electric used to be one, not anymore. So you can see how when companies, they just can't go to the moon. And we get a little bit concerned about that. Now, I talked about markets. We've had a great market over the past 2 years. And in fact, we are, as of Friday of the close, we are on the 2-year anniversary of the bull market. You can see we've had strong S&P 500 participation over the last 2 years. So we have to ask ourselves, how long can this market last? Well, you can see that the average bull market averages about 4.3 years and is up about 149%. And this goes back to 1942. The average bear market only lasts 0.9 years and sees a 32% decline. But as of Friday, this one's 2 years old and has returned approximately 60%. So it's still short. It still has only risen. If we compare it to average bull markets, only about halfway there. So if you just use history as a guide, this could go on for quite a bit longer. And that's a real positive for us and our clients. Now, I talked about the debt and I talk about questions I always get. Now, obviously, we can't do one of these without actually mentioning politics. And as Caitlin said, I did graduate from the University of Illinois way back when with a degree in economics. And one thing I've always said is that sometimes good politics makes bad economics, and bad economics makes good politics. Meaning, if we remember when Clinton ran, his chief of staff, I can't remember his name, said, it's the economy, stupid. And when you're looking at presidential races, it's the economy. And if the economy's good, then it's something else. But if you look at what economists oppose in favor versus what ordinary people oppose in favor, you can see there's a real dichotomy here. So you may think that imposing a tariff is good for everybody, not necessarily so. You can put tariffs up, but once you do that, first of all, is the country that you put a tariff up against, they're going to retaliate, number one, and that's going to drive inflation upward. And it's certainly not a panacea because, part of those cheap goods and services we got in the previous slide when I showed you, part of that is from free trade. Other things is penalize company that engage in price gouging. Who decides who's gouging what? Is NVIDIA at 75% margins price gouging versus somebody like Procter & Gamble? And who's going to decide that? So this is just a little note to show you that not necessarily what the politician's telling you, not necessarily what people want are going to be good for the economy. So before we do anything drastic, let's ask some of the people who know what's going on. Okay, a couple words on what might happen during the election. I think the conclusion here is that gridlock works. So when you look at when there's a Democratic president or a Republican president, you look at the makeup of Congress, both the House of Representatives and the Senate, you'll see that the split, more times than not, is where you get the best market performance, for the simple reason that if one party has complete control, they change things too much. Business leaders have a hard time figuring out tax rates, figuring out how much their cost of capital is going to be, all sorts of different laws and regulations. But what we can see is definitely gridlock works. It's actually not doing anything is best for the market. And the market always loves certainty over uncertainty. So let's start ending up here. I want to have some talking points for you to remember once we finish this. On the macro side, we are undergoing that soft landing, which is very rare out there. The last time this happened was 1995. We started easing in September, and everything's been good since then. Now, if the Fed starts easing too quickly, too fast, that is a sign that the economy is not doing well, and I don't think the market would like that. Longer term, as I mentioned, crowding out is our biggest risk. Equities in the stock market, the market is still quite dominated by those Magnificent Seven stocks, but they are widening. However, those earnings of those stocks have done quite well. Didn't mention much about fixed income. We are starting to look at municipal bonds right now. You'll get more on that going forward. Some municipalities in looking pretty good shape that we're willing to look at that for those clients that have taxable accounts, and then end up in that gridlock works in an election. And we're certainly not going to adjust any portfolios against any potential outcomes. First of all, it's just too close to call right now. Second of all, nobody is going to know what stock market are going to reaction no matter what the outcome is. So before I go on, let me just repeat this. If you do have a question or a comment, please email investment.team@trilogyfs.com, and Caitlin will certainly answer your emails. Let me just end up here with a couple comments longer term. I've been doing this over 30 years, and one thing I have noticed is that optimistic people are way happier and incredibly wealthier than pessimistic people. So if you take a look at where we are in the world, no matter what the press tells you, on top, world life expectancy near an all-time high. On the left side, world population living in extreme poverty, and we're talking extreme poverty of less than $2 a day, all-time low. And the literacy of world population is at an all-time high. So despite some things going out there, they're going to make you feel bad. It's never been better to be alive than right now. It's never been better in the financial markets. I'm looking at the screen right now. I think we're at an all-time high today. That's good stuff. And I just want to encourage everybody, especially on the investment side, stay positive. One thing I'm going to ask for you is some feedback. Please call your advisors. Here's a chart I like to put out. You see my charts and graphs. Sometimes my perception up there, it's easy to comprehend and it's fascinating. Not necessarily true all the time. Everyone else, you may think they're boring or hard to comprehend or somewhere in the middle. Certainly, if we want to get better at this, please call your advisor. And next time you talk to your advisor, if there's anything else we can supply you with, you let us know. And at that, I want to give you my favorite chart of all time. This is a quote by Simone Weil: "Attention is the rarest and purest form of generosity." And I want to thank you all for your attention in your business, because we know there's a lot of options out there, and trusting, and again, thank you for trusting Trilogy with your financial matters. Caitlin, let me kick it back to you, please.
Thanks, Mike. Awesome. Appreciate all of the context today. We do have our EVP Mike Broker raising his hand, so I am going to allow him to jump in here.
Hi, I just wanted to say thanks,
Yes.
Mike. Missed everybody. Can you hear me?
You're live.
Yes.
Oh, you did a great job. For the clients out there, Mike came on board a few months ago, and he's done a great job with Trilogy, getting us, I would say, leveled up in our investments and really taking us to the next level. And we really look forward to what he's going to do in the future. So thank you, Mike. Appreciate it.
Appreciate it, Mike, and I'm honored to have this position. Both you and Jeff thought enough of me to come on board, and I'm really excited to be here.
Mike Serio, I'm going to jump in with a question that we have at this time. I think that's a nice segue here. How do you foresee future changes to the way that Trilogy invests in Trilogy's portfolio landscape?
Great question. Traditionally, Trilogy, and they've done a really good job in the past, has been using the exchange traded fund vehicle mostly. Now, I think the exchange traded fund, the ETF vehicle, is one of the best inventions in the financial services business of all time. We've been doing a good job of that. I think going forward, what we're going to be able to do is to deploy some other tools and have a couple more clubs in the bag. A couple things we're looking at very closely is options management, is being able to hedge or create income for clients using the options market. Another one would be called direct indexing, which is a tax advantage strategy. And then eventually we're going to get to alternative investments, which includes hedge fund, private equity, commodities, et al. I mentioned that because, when I got into the business way back when, the only tools we really had were stocks, bonds, and cash. And if you were General Motors pension fund, certainly you had commodities and options and futures and all these other more sophisticated investments. And along with the ETFs, what gets really exciting in this business is we've been able to democratize everything and bring some of these vehicles down to people who maybe don't have 10 or $20 million. And so be looking forward for that. It's going to get very excited. And, and I say that, so if we do get an inflationary environment, it may not be great for the economy, but we will have tools at our disposal that actually do quite well in an inflationary environment. So stay tuned.
Thanks, Mike. One more question for you, Mike, and unless we get some additional questions coming in, we can probably wrap up a little bit early today. So this one relates to interest rates and the interest rate cycle. How many more times do you think the Fed will need to lower interest rates before we start looking at increases again?
That's a really good question, because we do have something called the futures market, and the Chicago Board Options Exchange, the CBOA, does publish what's baked into the derivatives market. And right now, boy, from now until the end of 2025, they're looking at 7 or 8 times they're going to ease, which is a considerable amount of easing going forward. I will tell you that gets very inaccurate more than 6 or 7 months out. I am guessing what they're going to do is probably ease at least one more time this year. It may be only 25 basis points. And then the Fed will tell you it'll be, quote, data dependent. It depends what the data looks like going forward. It's mainly going to be one way of measuring inflation, which would be the personal consumption expenditure. That's the PCE, we call it. That's going to be a big one. And then certainly the Friday employment statistics are going to be very important. So keep an eye on those. We could see, again, more easing out there. So there might be a chance, if we apply this to our client situations, there might be another chance out there to maybe refinance a mortgage or two at a better rate.
Great. Thanks, Mike. All right, I haven't seen any additional questions come in, so I would say it's safe to wrap up now. As a reminder, if you have any additional questions, please feel free to reach out to your advisor. You can reach out to that email address as well, investment.team@trilogyfs.com, and you can reach out to Mike or me if you have additional questions as well. Lots of resources available for you. These calls will be taking place each quarter, with our next call scheduled for Monday, January 13th, 2025 at 1:15 Pacific time, 1:15 p.m. And we're grateful once again for your time and your attention today. Thank you for being here, and I hope that you learned something. Have a great rest of your day.